Hello, I'm Peter Farley from IDC Financial Insights. I have with me Alex Kwiatkowski, who's our Head of Banking Research in Europe. Today we're looking at the report by the Independent Commission on Banking, led by Sir John Vickers, which has produced some pretty far-reaching recommendations into the future structure of British banking. Alex, you've got a chance to look through this. Are we really going to see fundamental change in UK banking as a result of these recommendations?
Fundamental change, I think perhaps not, but certainly some degree of change, yes, for certain. If you look at what's been proposed, this is possibly the most radical change that we're going to see to banking in a century. Is it going to go far enough? Does it protect the UK from further systemic risk? That's the part which is still, I think, unclear in my mind. Creating this strong yet flexible ring fence is going to be a fairly large task, and the detail behind that task is not yet sort of clear as to what exactly the banks themselves are going to have to do. So we are still at very early stages. This is just the first stage of probably a 3 or 4 stage process before we actually see whether this has really worked successfully.
What are the implications for the marketplace then, given those uncertainties and the length of time this change is going to be phased in, particularly in terms of new competition, which we see some interest in this market?
Does this open the floodgates to new competition? No. I think as part of the process we see the disposal of the Lloyds branch estate, or some of the Lloyds branch estate. That of course helps stimulate competition. Does this then suddenly say the UK is open for new competitors to come in from, say, foreign markets, as has been the case in the last few years? Will we see more of that? No, I don't think so. Are we going to see lots of new, non-traditional entrants suddenly thinking that, hey, banking is really the place to be? No, I'm not convinced by that either. I think it goes some way to stimulate competition. Does it really open up the banking sector in ways that we haven't seen before? Not by my interpretation of the Commission's findings. Certainly will have some impact, but perhaps not the wide-ranging, open up the market to competition and suddenly see materially better services and greater consumer choice. I think that would be kind of going a little bit too far at this juncture. Okay,
fair enough. Let's try and just drill down to some brass tacks relevant to our usual audience in the technology sector. What sort of advice or guidance would you give to senior bank IT executives or the IT vendor suppliers to the industry as a result of this sort of uncertainty?
I think kind of 3 things. One, at the moment, is just understand the implications and impact of the Commission's proposals, because of course we've all seen the report today. Now is the chance to go and digest and actually think, what does this mean for RBS, for Lloyds, for HSBC, for Santander, and then apply it to say, well, this is what we're being asked to create, this strong yet flexible ring fence. How does that fit with our systems today? How integrated or indeed unintegrated are our systems between the retail side and the investment banking side? What needs to be separated? What sort of reporting requirements will there be? We have a long time now to 2019 to kind of get this right, but I think there's some building blocks that get put in place quite quickly, which says, what are our data reporting requirements going to be? How are we going to manage business intelligence and analytics? All of these are good fundamentals. I think, however, there's a wider issue, which is the issue of kind of cultural change, which needs to come with this as well. So you can create a strong ring fence, which has some flexibility, but if some of the behaviours don't change along with that, then all the technology in the world still cannot sort of prevent the human factor from having a detrimental impact.
One final question. The cost implications of these new regulations have been widely touted, and the increased level of capital that the report recommends, up to 10% from 7% in Basel III, means that margins are going to be squeezed. Does this mean there'll be a requirement to spend more on technology, or will technology budgets be squeezed?
I think it's a great opportunity to actually be innovative, and so that you have that speculate to accumulate, which perhaps in banking hasn't always been the best approach to take. But I think if you look at what are the banks trying to achieve, new products, new services, a better overall user experience, you can't do that, as the old adage goes, you can't make the omelette without breaking 1 or 2 eggs. Do you need to buy more eggs to make the omelette bigger? Yes, quite possibly you do. Does that mean more technology investment? Yes, I think so, but again, carefully chosen in the right areas, whether that's in customer channels, and then most importantly perhaps the area of kind of BI and analytics, actually understanding how the business is running, having that finger on the pulse, having that confidence and that accuracy in what's actually taking place in real time, day to day.
I suppose we should also add that this is being done by the UK almost independently of other regulatory regimes. Should other banks in other countries be looking at what's happening in the UK and expect something similar?
Unquestionably. I'm quite convinced that they are. What remains, again, is an issue, something I'm uncertain about, is to what appetite other national regulatory authorities and other banks have to actually think, yes, the UK is pioneering and we want to go down that path as well. For sure there is interest in seeing what happens in the UK. Is the UK going to trailblaze? Perhaps it did in other industry sectors over the years, to say it was a real market leader and for other regulators, other institutions to follow. We have to wait and see. I would like to think that the Commission's good work over the last year is going to make a fundamental difference. Whether that's then reflected across the European banking sector, it's far too early for us to proclaim with any degree of certainty.
Fair enough. And how would you sum up then that the good or bad impact of these recommendations, given that some critics or cynics say that if the bankers like it, they haven't been tough enough?
I think that's a very nice way of describing it. I think if we looked at what originally was the motivation for this commission, which were undeniably politically motivated, part of the coalition agreement, and that I'm quite disappointed in some respects there's been this gradual dilution of what the Commission has actually been looking for. There's been lots of lobbying going on in the final stages, and what we have today is probably not as radical as I would have hoped a year ago, which is where we saw the real opportunity to perhaps truly structurally separate retail and investment banking, rather than this kind of halfway house that we've got now. The banks for sure are going to never be happy by being made to make fundamental changes to their business. Privately, I think a lot of them, just like they breathed a sigh of relief when the interim report was published, will be thinking, we've actually got away with this.
Thanks, Alex. I think it's a very good summing up of the situation. Thank you for listening, and I hope we've given you some thought-provoking ideas and things to stimulate some discussion in your own organisations. And obviously, Alex or myself would love to talk to you in more detail if that would help you with your current industry challenges. Thank you.